Hey, welcome back to my channel, friend. And if you're new here, hello, nice to see you. Have a seat, grab a cup of tea. Okay, people, do you know what the root definition of mortgage is? It literally means death pledge. The root word mort, meaning dead, and gage, meaning pledge, is in Old French. Aren't words fun? So it was called mortgage because it was very doubtful that the borrower would actually pay his debt within the time limit that it was due. And if he did not pay his debt by the due date, then the land which is pledged to the borrower, if he actually paid in time, is taken from him forever and is therefore dead to him. Or in more pleasant terms, mortgage basically means you're under a debt contract for the rest of your life. But as the title of this video suggests, you can actually escape this death bond and pay off your mortgage within a handful of years. It's possible. Very hard, but very possible. Thus breaking the cursed chains of mortgage bondage and freeing yourself into real property ownership, as long as you pay your property taxes. So, how do we beat the odds and pay off our mortgage in record speed? And I say "are" because we just bought a house. And so if you're looking to be on this journey with us, then hey, let's try it together. And as a matter of fact, let me know in the comments if you plan to try to pay your mortgage off in a few years, or if you have actually been able to pay off your mortgage in a few years. Let me know in the comments. I'm really interested in hearing those stories because they are very, very inspiring to me, considering the fact that now I'm under a debt contract and I'm kind of worried about that. So yeah, this video is just as much for me as it is for you, so keep watching. First of all, I think it goes without saying that I don't think everybody has the means to pay off their mortgage in 5 years. That is a very short amount of time if you don't have the extra means to pay off those mortgage payments, the extra money in mortgage payments that you'll have to pay per month. So I get it. I know that this is not realistic for a lot of people. Also, in retrospect, if you have a high mortgage that's like 3 times more than your household brings in each year, then that'll also add another level of difficulty in actually making this happen. Now, of course, you could always start a side hustle to bring in more money. You can always bring in more cash. But let's assume for the sake of this video that you aren't an early 2000s rapper who loves to hustle hard and all you have is your day job. Something that I think is really important for you to understand before you start this journey is that regardless of what kind of mortgage you have, whether it's an adjustable or fixed rate mortgage, very little of your mortgage payments goes to the principal of that mortgage loan at the very early years of that loan, okay? And the reason for this is the bank wants to make sure that they get their cut early. Remember, y'all, okay? Mortgages are meant to last through death, and banks just are not willing to wait that long. So for example, let me just break it down to you, okay? A $750,000 mortgage, right? And it's a 30-year mortgage with monthly payments of $4,026, pays approximately $48,314 in payments in the first year. And only a little over $11,000 of that is paid to the principal. It's only in year 17 that you'll be paying less in interest than the principal. All right, so in year 17 is when it starts to kick in. But even then, even in the 17th year, the number is still close to even with the principal and the interest payments. So with this example, paying your mortgage in less than 7 years can save you over $560,000 in interest charges. That's crazy. So the point here is that it's really important to pay down your principal as early in the game as possible. Okay, so the first thing that you need to do is tackle your principal so that you get your numbers right. So what you want to do is you want to use a mortgage calculator, and there's lots of free ones online, to calculate the amount of principal payments that you'll need to make every single month. Okay, so for the $750,000 mortgage example that I used earlier, with the $4,026 mortgage payment every month, can be paid off in 7 years as long as you pay an additional $6,574 a month. Okay, that's an additional almost $7,000 a month on top of the $4,000 you're already paying. Now, of course, that example does not represent the majority of people. The majority of people do not have a $750,000 mortgage, okay? And if you did, you probably wouldn't be watching this video, all right? I mean, again, most people can't afford that, and most people couldn't even pull off the additional $6,500 something a month in mortgage payments. That's a lot of money. So that's not to say that's a typical example. I'm just using those large numbers so you can get an idea of how much money you're talking about, you know? So this example, what it does though, is it shows you how much more money you will need to pay every month extra on top of your mortgage payments in order to pay down that principal. in relation to how much money your mortgage is or how much your mortgage costs. All right, so let's look at a mortgage calculator right now, and we'll work with much smaller numbers to see what we're looking at, okay? So let's say you have a mortgage that's $300,000. Now this calculator is defaulted at a $60,000 down payment, which is 20% down. But let's say you don't have 60 grand laying around and all you have is $20,000 to drop, which is only 7%, which with a 30-year fixed program puts your monthly payments at $2,037, okay? As you can see, 1,183 of that amount is going to your principal. Now, when I take it down to a 15-year program, your payment goes to $2,690. So if you wanted to pay this mortgage off in 5 years, you'd need to pay an additional $5,505 a month towards the principal. Again, now this is only if, of course, you only put down 7% as a down payment instead of 20%. But I know like the logic here is like, if I can't afford to pay down 20% in a down payment for my mortgage, then I probably can't afford to pay an additional 3 times my principal every month on top of my mortgage payment, right? Like, because that's going to bring you up to close to $6,000 a month anyway. So it's a lot, right? So for this example, again, if you have a $300,000 mortgage and you only put down 7%, then you will have to pay an additional almost $6,000 on principal every month on top of your almost $3,000 mortgage payment, okay? But that's only if you, again, you only put down 7% in a down payment, all right? So I'm kind of being really generous, or not generous, but I'm being really conservative with my example here. So I'm only assuming that you're gonna put down 7% on your mortgage. And I'm also assuming that you're going to get a $300,000 mortgage. I'm thinking that that's kind of like standard or relatively in the medium of how much people pay for their mortgages nowadays. But it could be a lot less than that, and you could be putting down a lot more than that. So just give and take whatever your situation is. But definitely use a mortgage calculator because they will put into perspective your numbers and let you know what you have to work with. Ultimately, my suggestion is if you really are trying to pay down your mortgage in less than 15 years, let's say, just save your money. Save as much as you can to put down a really good amount of money for your down payment to make your life a lot easier, because I mean, you're gonna have to pay more per month anyway to make that happen. So you might as well put a huge lump sum down on your home at first, at the beginning, and make it a lot easier for you to accomplish that 15-year program, okay? It's important to be realistic. Just keep it real with yourself. If you can't afford to pay more than double the amount of money on your mortgage every single month, then it's just not feasible to do that, okay? Anytime you get extra money, apply it to your principal. You can even use your tax refund to do it, okay? People do that all the time. Heck, even consider, taking up a side hustle to pay it off quicker. And also consider the amount of your home. You may just have to go under your budget and settle for a less expensive home if you're trying to pay off your mortgage quicker. And here's the tea for today, okay? Sometimes it doesn't even pay off to try and keep up with the Joneses. All right. If you look hard enough, them Joneses probably have 10 credit cards in collections. They're probably behind on their HOA dues. And they got bad credit, so they take out payday loans to buy their cars in cash. And now they got loan sharks coming and knocking on their door. And they aren't even allowed to go to their local Papa Do's anymore, because every time they go, they complain to the waiter about how their food is bad, and then they try to get their food comped every time. And the IRS is about to start garnishing their wages because they haven't paid taxes in 10 years. Yeah, you might not want to keep up with the Joneses after all. And the last thing you can do to try and pay off your mortgage quickly is to look into getting an equity line of credit. Okay, so this strategy requires good debt management, because ultimately you're going to be increasing the amount of debt that you have with a HELOC. So HELOCs work on simple interest, whereas mortgages work on compound interest, which is what makes them so expensive. A $20,000 HELOC, okay, with a high 7.5% rate, only really comes down to a monthly payment of $125, all right? So using that $20,000 to pay off the principal of your mortgage is a much faster way, an efficient way to get down that mortgage payment a lot quicker. It might be more in your budget to pay down the mortgage $20,000 and then pay that off in less than a year with $2,000 a month. The thing with HELOCs though is that you have to have a certain amount of equity in your home first. So it's no matter what strategy that you choose, you're gonna have to have a good amount in your home. You're gonna have to have a good amount that you've already spent towards that mortgage, which is why, again, I'm gonna go back to telling you to make sure that if you're trying to get a home right now, make sure that you have enough money to put down as for your down payment. Okay, you want to have as much money as possible for your down payment. As much as you can save, do that. And it has to be feasible. So again, if you're not bringing in that much money, then you don't want to go for a really expensive home, because it's going to take a lot more cash to save in order to put down a substantial amount of money on your down payment. Again, a $300,000 mortgage is a good amount. It's standard, but 20%, which is the amount that you should be saving for a down payment, is $60,000 on a $300,000 mortgage. That's a lot of money. That is a salary that you're gonna have to pay, save. So it's possible though, and you just might have to wait a few years to save up that money. It's very possible. We saved $40,000 one year, and I have a video just all about that. So it's very possible, but it's about, you know, being patient and just being really good with your money and managing it very well, so that you have these options like the HELOC, or, you know, being able to have a little bit lower monthly payments towards that principal so that you can get it paid off a lot quicker. So anyway, that's just my suggestion. Down payment is very important. And a part of that too is making sure that you're good with money management. You know, you might be spending money on things that you can kind of cut back on. You know, if you still have cable, what are you doing? Cancel your cable. All right, that's like probably several $100s, maybe even $1,000 a year that you're paying on cable when you could just be streaming. You know, if you're eating out all the time, like every single day going to lunch, stop it. Don't do that. Pack your lunch. You know, make sure that your grocery bill is enough to where you have enough food to where you don't have to go out every day, go out to eat every day, because that's a lot of money. It sucks a lot of your cash. A lot of things that you don't think that you're spending a lot of money on, or that are small, but they accumulate over time, like again, eating out. So anywhere you can think about cutting down on expenses, do it. And you can also try to do things like lowering your car insurance payment every month. You know, talk to your car insurance people. They'll work with you. You know, however you can to save a few bucks. Those few bucks, they accumulate again, you know. And so that's just one of my tips, you know, as far as savings, because you're going to have to save anyway. If you're going to buy a home, you have to put down some kind of money on a home. And so definitely consider saving money, cutting down on expenses that are not important. And I'll do a video about saving and things like that in the future, so be looking out for that. So there you have it. It's not easy to pay off a mortgage in less than 15 years, especially if you do not have extra streams of income coming in. I think it's very important to diversify your assets. That way you have more financial freedom and you have more flexibility with how you spend your money and the things that you spend your money on. Again, that HELOC, having an equity line of credit, you know, things like that. You don't have that option if you're not saving your money or you're not getting income from other places. These types of things really impact your finances. So having control of your assets and also diversifying your assets and having extra streams of income really help with that. Okay, so if you want to know more about the different type of businesses that you can start from home with very little barrier to entry, then watch this video right here, okay? And again, let me know in the comments if you plan to start paying off your mortgage in less than 15 years, or if you have done that, let me know. Tell me your story, because I'm really interested in hearing about it. And if you found value from this video, throw me a like. And if you want more content like this about personal finance, building generational wealth for your families, subscribe, help you grow out. And until next time, friends, bye.